All right. Hello, everyone, and welcome to the 2022 award presentation for the Harvey R. Miller Outstanding Achievement Award. This year's honoree, I'm happy to say, is Jeff Aronson of Centerbridge Partners. And for those of you that don't know, I'm Lisa Donahue, and I am the global head of the turnaround practice at Alex Partners. And I was honored to be last year's award recipient. Jeff, I think you know I couldn't be happier than to be the one to be presenting you with this award. And it is such a prestigious award, and so many folks that we both know in common, and I know you're particularly close with, have been past recipients, including Harvey himself, of course, Art Newman, Ken Buckfire, Jim Milstein, Jay Alex, Al Koch, the list just goes on and on. So before we dive into the conversation, I just want to say congratulations. I'm so happy for you, and I can think of no one more deserving.
Thank you, Lisa. I have looked at the past list of honorees. It's a great group to be part of, particularly because, as you say, you know, I've known many of them for quite some time, including you.
Right.
Lisa, we've been friends for 25 years or so.
Crazy.
Really
It's actually amazing when you say that out loud, right? So anyway, let's dive right in, because I think there's a lot about you that people are going to want to know and get to know the Jeff Aronson that I know so many of your friends know. So maybe let's start a little bit with your career and background. It's pretty interesting. Starting out as a lawyer, going then on to, I guess, Rothschild Advisory, and then on to Angelo Gordon, and then starting Centerbridge. A lot of change. And although it's a little more common now, I don't think it was quite that common back then that people made those sorts of jumps. So you want to talk a little bit about that journey?
Sure. Well, it has been a journey. You know, I started off as a corporate lawyer at Strzok & Levan, and I was doing corporate work. And even though I enjoyed law school, being a lawyer, I wasn't cut out for it. It wasn't me. So I ended up finding a job. I think I lasted 2.5 years at Strzok. So I flamed out pretty quickly, and I found a job in the legal department, not Rothschild that we all know, but a firm that no longer exists. It was called L.F. Rothschild Unterberg Tobin.
Oh,
this was a long time.
I thought it was the Rothschild, the Homer Fairfield Rothschild. Oh, okay.
So many Rothschilds. Again, this is back in the mid 80s. And my job, I was a young lawyer. My job was to be basically the in-house junior counsel for the group that ran the firm's proprietary capital. This is back, I think, in like 86. And the two people who ran the firm's capital, one was named John Angelo, the other was named Michael Gordon.
Ah.
And that firm proceeded to implode after the stock market crashed in 1987. So my first real life experience with distress, and ultimately the business ended up filing for bankruptcy. And around the end of 88, beginning of 89, John Angelo and Michael Gordon said, we're going to go start a firm. And I raised my hand, I'm going with you.
Wow.
And they said, well, you're a lawyer, you can't add. And I said, yes, I can. And so there were about 12 of us. And I transitioned from being a lawyer to being an analyst. And I went to NYU Stern at night, because I had never taken basic accounting or corporate finance. And unlike law, I really enjoyed it.
Right.
Had an aptitude for it. And so I was at Angelo Gordon from inception, and I left in 2005, which is now 16 years ago, because time flies, to found Centerbridge with my friend Mark Alogli.
You know, that was kind of bold when you think about it, because now the notion of a firm with multiple types of funds and a natural arbitrage with a hedge fund and a private equity fund and two folks from a little bit different background, both investors, starting a fund, back then it was a really new idea, and it was kind of revolutionary. Maybe talk a little bit about how you and Mark got together and the start of Centerbridge. And I know I was one of your references, so I know what was going on, but talk about it a little bit from the founder perspective.
Sure. So I founded Centerbridge with a good friend of mine named Mark Galogli. Mark, prior to founding Centerbridge with me, he ran Blackstone's private equity business. And that's when Blackstone was a much different firm, basically an enormous private equity business, a very small real estate business. They had a fund-to-fund business. And as you know, they had a financial advisory business back then led by Art Newman, with Tim Coleman as, you know, a very senior partner there. Other folks, Steve Zellin, many others as well. Mark and I met about 2000, and we were actually introduced by Art Newman, who was at Blackstone, because Mark was very interested in credit, but you know that wasn't their thing. They were pure private equity investors. You know, GSO; those were just three letters in the alphabet. They had no credit business.
Right.
And so Art was the matchmaker, and he said to both Mark and me, "You two should meet each other." And we did, and we hit it off. And we decided, again, this is 20 years or so ago, we formed a joint venture between our firms. We actually called it Project Spock, for where no man had gone before. And
Which
the
one
idea
of you was the Star Trek guy? You?
I don't know. I think that code name came from Blackstone, actually. And the idea simply, and it sticks with us to this date, and I think many people attending this conference will be well aware. I kind of describe our strategy. Think about a firm, company's balance sheet. Very simple. That classic T, assets on the left, liabilities on the right. Credit investors, including myself, my edge as an investor, I was really good on the right-hand side of the balance sheet. That's what I understood. Capital structures, liability management, who gets what, event analysis, game theory, restructurings. But truthfully, less skilled on the left-hand side. Private equity investors, if you think about it, they're the exact opposite. Great on the left-hand side of the balance sheet. Deep understanding of businesses and how they work and how they run from the inside, how to value them, but less experience on the right-hand side of the balance sheet. So that was the original thesis 20 years ago when Mark and I partnered together, and it was really successful because we each brought our respective skills to the table, and we did everything 50-50, just on a handshake. And 2004, 2005 rolls around. We had both been at our firms since the 80s. And we thought this idea of having, I would say, I try to think about it, best of class talent from both worlds, operating as a single unit, was like a smart thing to do. And that's where the name of the firm came from, that we were going to bridge these two strategies to the center.
Wow.
And just the two of us in a friend's conference room when we started, and you know, it's been it's been a great success.
It's been a great ride. It really has been wonderful. Anything you would have done differently? Now you've got the benefit of looking back 15 years. Anything that you would have thought about, I wish I did this different, anything like that?
Good question. It's a good question. I'm sure there's a host of things. I think most of what we set out to do, we did. We wanted to build a real partnership. We weren't interested in selling the firm. We didn't really want to work for one at this point.
Right.
We were very conscious about thinking about the next generation, because you know, for an organization to thrive, you have to push down responsibility. You have to push down economics.
Mhm.
Because I find that many founders suffer from an inability to let go.
Right,
And that's not surprising because the business becomes, you become the personification of the business.
right.
And neither Mark nor I, we saw that for us. So Mark actually, and Lisa, you know this because you're good friends with Mark. Mark retired from the firm at the end of last year and
Right.
went into the Biden administration to focus on climate. And I've told people very plainly, no, I'm not doing this forever either. So
I don't know that Sherry would let you do it forever either.
I have honestly, I've like no regrets. I'm sure, look, there's a ton of investments that,
Yeah.
I wish we had made.
The one that got away. Right,
There are definitely investments that we did that I wish we hadn't done, but that's
Right.
the nature of being an investor.
right. One thing I will say, and I'm not just saying this because we're friends, I think you've got a really high caliber team, and you've got reasonable people to work with. They come up with, and as you know, and what I do, I end up across the table with a lot of them sometimes.
Mhm.
And the fact that you're solutions based and your guys do think out of the box and they're creative, I think helps get to solutions for companies and for clients. Is there something that you or Mark or you and Mark together kind of instilled in the group, or do you just simply try to hire folks that are consensus based, solutions based kind of folks?
I don't think we went out looking for solutions oriented people.
Mhm.
I think, the people who joined the firm first were drawn by this model that we built. So we don't
Right.
have kind of one team that does everything, does buyouts all the way through distress. So people invest up and down the capital structure within their area of industry expertise.
Mhm.
And then we have certain specialists who may focus purely on restructurings or purely on value creation programs in the middle of a business, is something, Lisa,
Right.
that you know a huge amount of, or trading functions. But generally, people invest up and down the balance sheet. So one, we attracted people who were drawn to that. And second, we kind of insisted that we only wanted people with their egos in check. There's so self-importance in our business.
Yeah.
And I kind of like it. I think it's misplaced. I think
Yeah.
what we do is important. People trust us with their money. Okay, that's an important job. That doesn't mean that what we do is actually important, and because we're fortunate and it can be a lucrative profession, that doesn't confer like
Yeah.
greatness on us. And so just people who have their priorities straight. And like I look at our team, particularly our senior team, I would compare it against any firm in the world in the credit business in terms of breadth of experience and success. Hands down, we would win.
One thing I learned a long time ago is there's lots of really smart people out there. There's lots of talented people, but when you're going into the trenches day to day, you want to be with people that you like, people that you respect, people that will do the thing. And that's a huge part of it. So one more question that has a little bit to do with Centerbridge, but a lot to do with kind of you as a person. One thing, and I know because I'm not going to talk about the peanut butter and jelly sandwiches.
Okay.
Sorry. Well, maybe I will if I have time. But you've been someone who has been supporting diversity, equity, inclusion, fairness, really truly for a long time, and long before it became something that everybody's thinking about. And I know this because we've talked about it a lot. We've shared ideas of our respective firms and how we can get folks in. So one thing that's really interesting to me is the CUNY work that you're doing along with Bloomberg and Goldman Sachs and others. Can you talk a little bit about that, and not just the program, but why? why is it so important to you, and
Sure.
why did you decide that this is something that you're going to get behind?
I mean, a couple reasons. I've been really lucky in life. I've been like super fortunate. I've got a beautiful wife, great children. It's all good. But a lot of my success was attributable to others.
Yeah.
So, when I went to both college and law school, I didn't have any money. So I went through the kindness of others, scholarships and things like that. And then when I started my career, I had two people mentor me, John and Michael. They took me under their wing and they really taught me. And it sounds corny. It gave me a lot to be grateful for.
It's not corny at all. I get it.
It's great. It's great to give back. It's great to give back. It's great to help other people. I find it personally super rewarding. And, it's particularly pronounced today, what's happening in the country, what's happening here in New York City.
Right.
And how do you create opportunity for others with this, widening gulf between people? And so it's something I thought about a lot, and thinking about it in terms of hiring young people. So what I find is that firms like us, all our competitors, we all fall over ourselves. We all recruit the same people from the same schools and things like that. And I joke, I couldn't get a job here. If they looked at my resume,
Neither could I.
they would toss it right out the window. And so how are we going to find different people? And, I had gotten to know CUNY with my wife, Shari, years ago, just from a philanthropic standpoint. And we have, and for all of you New Yorkers who are listening, we have an incredible undiscovered jewel right in our backyard of smart, hardworking, diverse young people. So I know a lot about CUNY now. CUNY,
No, we need to tap it. Yeah.
It's so interesting. CUNY has 11 or 12 four-year colleges. There are 180,000 students enrolled in the CUNY four-year college system. That does not include community college.
Wow, that's amazing.
There are more, and it's a huge number. It's a crazy
Right.
number.
Yeah.
And most of them, they're people of color. They're often first gen, and they just want a chance.
Yeah.
So we started hiring them at Centerbridge 2018. We started a program to take these young people, and they were like, oh my gosh, there was none of the millennial stuff. They were just they were so appreciative and just as smart as everyone else and hardworking. And I thought, there's a huge opportunity here for the entire financial services community, which are hungering for talent, hungry for people like this. So I went to two people I know well, Mike Bloomberg and John Waldron, who's the president and CEO of Goldman. And I said, I have this idea, and why don't the three of us work on it together? This was all pre-pandemic.
Yeah. No, you've talked about it for a while, so it's amazing.
And we were ready to launch it, and what we were doing, because we all had our own hiring programs out of CUNY, the idea was I wanted to bring this to the entire financial services community. All of our competitors, it's like, great, you should go hire these people. And the pandemic hit, and everything went on hold, and CUNY was really hurt. But now, as things have gotten better, I mean, it's, I think, even more of an imperative. And it's a huge win-win. It's a no-brainer. It's a win for these young people. It's a win for New York City.
Right.
And it's a win for employers who are looking for hardworking, smart, young talent. So we kind of rolled this out publicly over the summer. There was a nice Wall Street Journal article on it. And beginning of next year, because we're investing millions of dollars between ourselves, Bloomberg and Goldman in CUNY, so they can develop the resources to basically act as the bridge between these students and the employer base. And so it's something we're going to roll out to the entire New York City financial services community at the beginning of next year. So it's a really cool thing.
It's so cool. And, you know, you're a guy that puts his money where his mouth is. You say what you're going to do and you do it. And I'm looking forward to talking to you more about it, because it's something all firms struggle with. So we need to get the word out. We need to think about ways to help this program, help these kids. And I'm excited about it.
Yeah, I literally think we're going to create hundreds of really good, well-paying jobs. And they don't have to be as an investor, as a trader, as a banker. Okay, there's so many jobs in financial services, from human resources to tax and accounting to compliance. I mean, you know, to tech. There's so many jobs in our field.
Right.
I mean, I'm all in.
You're evangelical about it. And I think
yes, I'm really passionate about it. I really believe.
I think that's great. All right, I'm going to switch gears a little bit, because I think the folks listening in would be probably pretty annoyed if I didn't try to get some market views from you. Where are you seeing opportunities as an investor right now?
Well, investor is pretty broad. As a distressed investor or as an investor?
Maybe let's start distressed, because this is kind of the distressed.
I'm not seeing any opportunity.
Yeah.
Certainly not here in the United States or even in Europe for that matter. And I learned this. I mean, I've been doing this since the 80s, so I have a lot of perspective. And I've seen plenty of people come and go in the business. For those of you who are actually professional investors in distressed credit, from my perspective, the most important thing to remember, and if you remember nothing else from my conversation with Lisa, is that this business is really, really cyclical. And if you can keep that simple fact in mind, you can do really well. It's when you forget it that you inevitably fall off the rails. And so I think what we do is really hard. It's complicated. I mean, I love it. It's like doing puzzles.
Yeah.
But if you step back, there's a lot of common sense. It's like, the economy is great. Now, we have an advantage. We don't have to call an economist at a bank to get a sense in the economy, because in our private equity business, nothing to do with distress. Distress is a four-letter word. If you're in the private equity business,
right?
We own 30, 35 companies across most of GDP. So we speak to the CEOs of our portfolio companies.
Right.
Which is hugely valuable. And the economy is really good. So demand is strong. Companies are making money. You know, there are plenty of issues. The inflation thing is a very real thing. We're seeing it on the ground.
But what about the supply chain challenges?
Yeah, it's a real issue. You've got a strong economy. You have markets at all-time highs.
Yes.
You have interest rates incredibly low. Credit spreads are super tight.
Yeah.
And there's tons of liquidity. If you're a distressed business in today's US economy, you're probably, not always, but probably not a really great business to invest in.
Right. Right.
That's just and there are always aberrations, you know, because people make mistakes, or there are extraneous factors, litigation, or some type of climate disaster. There's fraud. But by and large, you know, the default rate is low now for a reason.
Right.
So if you're defaulting now, it's probably not great. So our distressed investment activity now is nil.
Right.
You know, 18 months ago, we were investing billions of dollars. And there were some other investors doing it, not a lot. I think a lot of people were kind of watching and waiting, and we were pretty aggressive.
Right.
So it's really cyclical. So we don't see a lot of opportunity now. There may be opportunity elsewhere in the world. You know, everyone about China. That may well be the case. But for us, because we're not on the ground there,
Mhm.
and we don't know anything about it, it would be a speculation. And
Right.
nothing wrong with speculating, but we've chosen not to. It doesn't mean that there are other firms that are, that are global or that are on the ground in China and have been there for a very long time. They may well find a great opportunity, but I know enough that if you don't understand something,
Right.
best not to do it.
Stay away. Stay away.
Yeah.
So when do you see the restructuring market coming back? I know you don't know.
I was going to ask you.
Well, I'm one of those people that is very optimistic, and you'd mentioned that the economy is strong, and I think that on the surface that's right. But you do see inflation, you do see the labor shortages, you see the commodity prices. So you do start to wonder when do the cracks start appearing? And yes, liquidity is very strong, and you think about a lot of those companies that took the CARES Act money.
Yeah.
And that is fantastic. But what they also got was the CARES Act debt. So they have a lot of cash, but they still have a lot of debt. So part of me wonders, when do we start seeing some of the cracks in certain industries? Because it's inevitable. It's just a question of when and where.
And it certainly is industry by industry. So,
Yeah.
if you think about companies in the auto supply chain, okay,
Right.
it's like, it's not a today thing, but we're always trying to anticipate the future.
Right.
So where are those businesses going to be 5 years from now? Now,
Right.
query whether they'll be good investment candidates, even though they're going to be going through some change, that remains to be seen.
Right.
But I think, look, I'm a contrarian. I generally invest in things that no one else wants.
Right.
So it kind of bothers me. I believe the conventional wisdom now. I think the economy is really good. I think we're in for smooth sailing with one big caveat, and that is if the Fed falls behind the curve.
Right.
I kind of think they are now, but I think the politics make it very tricky for the Fed to navigate,
Right.
which I totally understand. But this inflation is real, and it has yet to manifest itself in terms of the market.
Right.
One of the challenges, though, the last time inflation was a real thing, I was in school. Most people, I bet many people who are at this conference, there's no way they were in the workforce. So you would have to be well into your 70s. And just think about that to really understand what it's like to work in a truly inflationary environment. So none of us, we don't have that muscle memory.
Right.
So I think kind of like watching and waiting, but I think, if the Fed sees the need to move interest rates faster than they've expected or sharper than they expected, they're very careful in their language. Tapering, that's a great
Right.
word. Everything is gradual, transitory. It sounds very soothing. But, they operate in the real world, and it's a real thing. So we're kind of thinking about not next year, but what's going to happen over the next 1 year, 2 years, 3 years. Because I agree with you, Lisa, and it always changes. Human nature never changes.
Yeah, it does. And I think about, you mentioned the auto sector, and I think about the suppliers, and I think about how tight that supply chain is, and how the kind of hand in glove communication with the OEs, telling them what their forecasts are going to be and what
Yep.
their volume is going to be, and everybody's planning kind of in a cascading manner. But then you started with the chip shortages, and that meant factories closing down. So these suppliers are getting whipsawed. And that's real. That's
Yeah.
real. And the shortage of long haul truck drivers. There's a lot of things in the system that have to be rethought. in my view, are you onshoring? I think there's just a lot to think about that does make me think that 2022 at some point, something's going to crack. I don't know if it'll be a major crack.
I don't think so, absent like a shock like I described, like the Fed
Okay.
wakes up, like, hits the brakes hard or something like that. Looks pretty good.
All right. Well, we'll
It's why
see.
we built our business the way we did.
Right. Yeah.
Because if we only did distressed credit, right now we would have billions of dollars and nowhere to go. And I know what would happen. We'd start rationalizing.
Yeah.
And we'd look at something that's been picked over 50 times.
Right.
And we would then I can almost hear it when people start saying, well, this investment, it's okay, but it's safe, which means run for the hills, don't do it. Because you see the same patterns every time. People have too much money, they feel compelled to use it, and their likelihood of making a mistake just rises.
It's funny.
I'm very cynical, though. I'm very cynical.
No, but I remember a few years ago, or some years ago, you returned some money. And I'm wondering if that was a little bit in the back of your head. There was no place to invest it, and you returned it.
Yeah, well, it's not our money.
Right.
I mean, it's kind of simple.
Yeah.
And if we don't have anything, and I really believe this, if we don't have anything good to do with it, we should give it back to the people whose money it is. Right.
Right. All right. So almost done. Hopefully this wasn't too painful for you. What kind of advice would you give young folks who want to get into our industry and I guess specifically distressed investing? What kinds of things would you tell them to think about as they consider a career in distressed investing?
Look, as I said, I love what I do. It's like I describe it, it's three-dimensional chess. You have to understand businesses, how to value businesses, the same way that a stock picker at BlackRock may, or Fidelity. You have to understand businesses. Then you have to understand, I'll call it, game theory and event analysis and things like that. There's a large legal component to this strategy. It's not a coincidence that many of us who are in this field are ex-lawyers. So that's the second component. And the third is, it's often a market-facing strategy. So you have to understand markets and how markets work. So, I think it's great. I think it's really intellectually stimulating.
Yeah.
It's highly profitable if you're good at it. So it will attract people who certainly intellectually curious, but most investors are intellectually curious. People who are attracted to all, those three components of my three-dimensional chess game.
Right.
You have to really be interested in all of them, not just one.
Yeah.
So you kind of have to be honest with yourself. Is that something appeals? And then again, you have to recognize if you really want to be a professional investor in this field, you have to recognize the cyclicality of it. I'll often ask a question to young people, young investors, what's the hardest thing to do as an investor? And I get all types of answers, building the model, what's the terminal multiple, figuring out what a court is going to do. And those are all good answers. But in my mind, what's the hardest thing to do as an investor? Nothing.
Right.
Nothing.
Right.
It's okay to do nothing. If there's nothing good to do, you're not supposed to do anything. And so you have to be incredibly disciplined and dispassionate, and you have to be even-keeled.
Right. No, great advice, and I agree. So thank you. I really appreciate your taking the time. Congratulations on this award. It is so well deserved, and thank you.
Well, thank you, Lisa, and it's a treat to get it from you. Bye, everyone.